Okay, so today I want to talk about an important fact of investing, or I more want to answer a question that I think will help a lot of people with their investing. So this question is it risky to invest in stocks? Now I think that from, financial news where you only hear about disasters or, movies like Wolf of Wall Street, you might perceive the stock market as being a very risky place with a lot of uncertainty, and it can be just that. You can lose a lot of money messing around in the stock market. But to answer the question, is it risky to hold stocks? I come back with a resounding no. And the reason for that is you need to minimize the risk you hold and have a longer time horizon. So doing these two things will help you hold stocks but not take a lot of risk. So to do this, I looked back to something around 1950 January. I looked at the S&P 500 price till today, which is July 27th, 2015. So, and almost no matter what date I picked, what starting point I picked, whether it was 1950, 1960, 1975, 85, 90, up to 2000, the returns didn't change a whole lot. So you're looking to earn about 7 to 9% depending on when you started, right? And that would be if you held a diversified portfolio and had that long time horizon that I'm talking about. So what do these two things mean? Diversified stock portfolio means you're not having all your eggs in one basket, just like you might think. So when you're looking at a fund or let's say an ETF or a mutual fund that you might want to invest in, you want to make sure that they have a lot of holdings. You need at least 30 holdings, ideally many more, and many of the funds will have more holdings. And you also don't want the top few holdings, the top few largest holdings in any fund to be huge. So when you look at a lot of mutual funds, they might hold 10% in a single bank, 5% in another, 7% in a big energy company. And before you know it, they might have quite a bit of value tied up in just a very few companies. Now, let's say you buy 3 or 4 different funds and they hold 3 or 4 of the same largest holdings. You could really be concentrating your money in just a few big companies, so you want to be careful. Now when you're looking at any mutual fund, just Google the name, or any ETF, just Google the name and find the company that issues it. And right online, you'll be able to look at the companies they hold, and in the biggest proportions, you'll see a MER usually will be there, and some other information about the fund that'll be useful to you. So you want to look in there and see number of holdings and what are the few biggest, and what are the percentages, and what percentage of the portfolio that those few biggest holdings make up. Now the second most important thing is your time horizon. Would I advise you to hold a lot of stocks in your portfolio for a long-term investment goal? Yes, absolutely. I think it's the best way to go. Would I advise you to hold 100% equity in, let's say, a fund you've put together to pay for your children's tuition if they're starting university next month? No, because you're going to have to make certain set payments, and you want to hold more cash-based assets like simple bonds, T-bills, certificates of deposit, those type of things that are not going to fluctuate in value. Because if September or August roll around and you need to make a payment today, and you'll know that date in advance when things like this are coming up, right? So if you need to make that payment today, but it was a bad week in markets last week, you could end up having to sell things at a loss or just at a value that isn't optimal for you. So you want to be able to plan that in the future. So remember, as long as you're diversified and have that long time horizon, holding stocks is not risky, and you can expect a return of at least 7 to 9%, somewhere in that ballpark, in the long run. Thanks.